Okay, well, and that's really good that there is this resilience with these properties. And when we talked about the economic conditions, now it feels like we're near the top for interest rates. Of course, we've all had the higher for longer drummed into us. But what are your thoughts on this? And surely that could make a difference for UK property. I'm going to ask that to Bjorn.
Yes, I think it will make a difference. Obviously, as we saw last week with the Bank of England's decision to keep interest rates stable, then the suggestion is that that stubborn inflation is being brought under control. There's a direct correlation between interest rates, cost of borrowing on property company net asset values. So I think the longer they remain stable, the indicators which suggest that inflation is coming under control will all feed into a positive reflection for property companies, which actually we saw very quickly through share price movement after that Bank of decision last week. So I think probably in the next 12 to 24 months, we may see some decrease in those interest rates, but not for the near term, I have to say. But stabilization is key.
Richard, what's your view here on rates and the impact where we are in the economy?
Funny thing, isn't it? We have got a rather upside down view of the world, having had low rates for so long, and with many of us, probably anyone who's got a mortgage, clamoring for interest rates to return to close to zero. But that's a sign of a sick economy. We should be able to support interest rates in the economy at current levels. And real estate has been an investable asset for many, many years, not just in the last 10 years with zero interest rates. But the type of property that you own, if you are funding your business with debt, needs to reflect the cost of debt. And happily, Custodian Property Income REIT has always pursued a strongly income-focused strategy, buying smaller regional properties to drive those higher marginal returns. And we are confident, particularly with the rental growth in the sector, that as our fixed rate debt runs off over time, and it runs out till 2032, so perhaps it's easy to make that prediction with such a long term on some of our fixed rate debt, the portfolio will support the increased cost of debt. And it wasn't such a long time ago in our working lives when we were pleased with interest rates of 5%. And real estate operated perfectly well in that environment. So we just need to make sure we've got the portfolios that fit the interest rate environment we're in. And I think we should reasonably expect that they're going to be north of 4% for some time.